In today's video, I'm going to talk about the protection that many investors that lend their securities get from their service providers, indemnifications. In other words, what happens when the shit hits the fan? If securities lending is your thing, if you're a lender, a borrower, a vendor, an advisor, or just plain interested, then this is the place for you. So let's get started. Hello everyone, I'm Roy Zimmerhansl and welcome to another episode in the fundamentals of securities lending. Today I'm going to be talking about indemnifications. This is the first video of two I'll be doing on the topic, and in this episode we'll go through the foundations of indemnification. In the next video we'll dig into the issues, challenges, and opportunities for today and the future. The inspiration for this topic was a recent paper from Mark Faulkner, co-founder of Credit Benchmark, entitled "Something Better Change, Securities Lending Indemnification is Unsustainable in its Current Form." There's a link to Mark's paper in the description for this episode, and I encourage you to read it. The reason it's important is that there's a long-term secular decline in profitability for securities lending intermediaries due to, I guess it's a combination of regulatory, supply-demand issues, and competitive reasons. And in my opinion, the provision and cost of indemnification is not a level playing field. So it has a potential to distort outcomes and negatively impact the overall investment marketplace as well as securities lending itself. Now, there are multiple types of entities that act as securities lending agency intermediaries. Some are banks, some are securities firms, others may be trust companies or specialist entities that are set up specifically to provide only agency lending functions. And these entities may be regulated or unregulated, they may have deep pockets or be thinly capitalized, they may have committed capital reserves to the business or pay other firms to support them independently. The bottom line, know the service provider, their corporate strength, and how service resilience is ensured for their clients. Before I get deeper into the indemnification topic, I want to remind regular viewers that we offer both free and paid-for securities lending and repo training courses. You can look for links in the description. And if you find these videos helpful, please give it a thumbs up. And if you haven't subscribed yet, please consider doing so and ring the bell so you'll be advised each and every time I post a new video. What is an indemnification? Well, simply put, an indemnification provides investors an additional layer of protection in the event that their securities are loaned out to a borrower who goes into default. Now, why do I describe it as an additional layer of protection? Well, first, an agent lender determines the list of potential banks, securities firms, and other entities that it's prepared to engage with in securities lending. That means each potential borrower will go through a risk assessment of its creditworthiness. Once a firm has passed the agent lender's approval process, each of the agent's clients is entitled to exclude, include, and put limits on volumes with any borrower approved. So each investor really can therefore tailor its securities lending exposure to firms that it's comfortable having a risk exposure to. And remember that agent lenders are exactly that. They're agents. So the actual contractual principal exposures are between the borrower and the investor that owns the securities, even if they use an agent intermediary. After a firm has passed both the agent and investor tests, any loan transactions are over-collateralized. The value of the collateral that a borrower provides exceeds the value of the loaned assets. And those relative valuations are tested every day and collateral is topped up or excess collateral is returned. Now, in the very unlikely event that a borrower defaults and the collateral is insufficient to return the investor to the same position it had prior to lending to the defaulting entity, the investor is potentially at risk of loss. And that's where an indemnification kicks in. The agent lender providing the indemnity steps up to the plate and makes the investor whole. The bottom line is the indemnification is the final part of a waterfall of protections. Not all indemnifications are created equal. Now, when we look at indemnifications, we can see two different aspects that need to be understood in order to make an assessment of the degree of the protection and the strength of that protection. One is which potential losses are covered, and the second is how are the indemnifications provided. What's covered? Well, probably the only feature of all indemnifications is that they provide for the replacement of the loan securities or a cash equivalent value. The indemnification provider ensures that the lending investor receives back the securities loan to the defaulting broker or cash equivalent. The other areas of potential loss may vary, so it's really important to explore and understand what else is covered and what isn't. For example, the loan securities may have outstanding dividend or interest payments owed by the defaulting entity. And the same could apply to outstanding corporate actions that are owed to the lender. Now, these two components are important, as had the investor not been lending, they would have automatically been entitled to those benefits. Now, fees, on the other hand, are an extra benefit from lending, and really they're the return that an investor gets for the risk of taking, the risk they're taking by lending. So some but not all indemnifications cover outstanding lending fees from the defaulting entity. And there will always be an accrual of fees just because of the timing and dynamics and mechanics of how fees are calculated. Now, it's really important that an investor that's contemplating lending and relying on the indemnification, or an investor that is already lending with indemnification protection, understands completely what is and isn't covered by their agent. So look, that's what is covered. What isn't covered? Well, usually cash collateral losses aren't covered by indemnifications. Now, why is this important? The overwhelming majority of securities lending losses occur as a result of cash investments, not securities lending itself. Those losses might be caused by buying investments that default in themselves, so you can have a loss without a borrower default. Good investments that get sold at moments of crisis and are hit by illiquid markets. Inappropriate investments, for example, long-dated investments, or those with low natural liquidity in normal markets. So the bottom line is know what is covered and what isn't covered. Now, who's covered by indemnifications? Well, typically, institutional investors using agent lenders are the beneficiaries of indemnifications. However, not every agent lender offers indemnifications, and some agents offer clients a choice of whether or not they want to be covered by indemnifications. Now, why would an investor not want the added safety of an indemnity? Well, of course, if they're given the option by the agent and they choose to opt out, then they would expect to get a better fee split, as there would be less risk for the agent. That's the bottom line. An assessment by the investor that the higher fee split is more valuable than the protection that an indemnification provides. Or maybe it's the view that borrower defaults are so infrequent and that the investor can really exclude any borrower at any time, and since they have that option, the risk of a borrower default at any given point in time is low. Or maybe it's the sense that if there is a default and the collateral doesn't cover the full replacement, that the residual amount that isn't covered is relatively small, so that the investor is better off taking higher fees year in, year out, and taking the risk of not having an indemnity in place and covering its own losses out of the additional fees that they've earned over the years. Remember that before the indemnity comes into play, the agent lender disposes of the collateral and uses the proceeds to buy back the loan securities and cover any of the other monies owed by the defaulting borrower that are covered within the context of the indemnification. And it's really only after the collateral proceeds have been exhausted that the indemnity covers the residual shortfall, if there is one. So the bottom line is, how likely will there be a borrower default? And if there is, how likely is it that the collateral will cover any shortfalls? How do agents actually provide indemnification? Well, really, there are four primary methods that they use: capital reserves, insurance policies, bank liquidity lines, and risk transfer. Now, where banks provide an indemnification to clients, they'll be required to reserve capital against those exposures. So there is potential for different banks in different jurisdictions using different internal risk models to incur different costs for the same exposure. Now, the Basel regulations have over time tried to bring more consistency and standardization to this, but inevitably that means that there'll be cost variability, and the question should really be, is the cost of capital really commensurate with the risk that the banks are taking? And look, that's a common issue for banking regulation, not just securities lending. There are third-party insurers that will write coverage for securities lending exposures, and I've helped clients in this area before. Insurance is an interesting solution as insurers provide risk diversification because they're less correlated to banks than other banks and securities firms are. Some agents have bank liquidity lines in place that enable them to draw on the line to cover any additional funds required to make a lending client whole as part of the indemnification. Finally, there are also third-party protections or risk transfer transactions where another bank may provide indemnification protection to an agent. And I was involved with one of these, putting one of these coverage plans in place at an agent that I worked at in the past. Now, my expectation is that in future, there'll be more clients opting for unindemnified programs, as well as more agents providing hybrid programs combining one or more of the different solutions. So the bottom line is each method has strengths, weaknesses, limitations, constraints, and costs. Now that's it for this video. In the next video, I'll provide a more detailed exploration of the issues that I've raised here and give you my views on whether indemnifications are beneficial for lending investors. I hope you found this useful and informative. I'm Roy Zimmerhansl, your host for the Fundamentals of Securities Lending. Have a great weekend, have a great week, and I look forward to catching you next time.